Hello and welcome to chapter 12 of the Accounting Insight tutorial series. In this chapter we are going to be dealing with accounting adjustments. So while the trial balance is a good stage to reach when preparing your records of accounts, when you look closely at the invoices of the business, you will find that there are further adjustments that can be made. And I'm going to go through these adjustments here with you. This is what the management accountant or the financial accountant will prepare before they produce the final figures for the profit and loss account and the balance sheet for the business. So the first adjustment we need to look at is telephone charges. So if we looked at the invoice from a phone call, so I'll just quickly go to it. Our purchase invoices are there, and we go to the invoice for the phone call. Here you can see that the invoice relates to charges from January to 30th June, and the company incurred £47.10. They haven't received an invoice for the second half of the year, and if you remember, we're preparing accounts for the full year, 3,000. So it would be reasonable to expect a similar charge for the second half of the year. So in accounting, we'll prepare a journal to show this expense. Go back to chapter 12. So in the book, we have prepared the journal here. Estimated telephone expense, £47, and we'll put an estimated liability for it because we're doing double entry system. We call this an accrual of expenses. So that would be journal 1, and we'll enter it as follows. So we'll put journal 1 there, and we'll say a further £47 of expenses to bring your total expense for the year to 94. And using the double entry system, we'll do the credit side as a liability, and we call it an accrual expenses. So it'll be journal 1, and it'll be £47. So in my Excel sheet, I have prepared what we call an extended trial balance. So we've got our initial trial balance here, and I've got journals that are going to adjust these figures, and this will give me the final balance that is going to be used for the financial statements of the company. So that is the first adjustment. We then go to the second adjustment, and here we'll talk about it. It's the insurance. So if we look at the insurance invoice, go to insurance, here you go. And if you look at the detail of it, you see the period it relates to is 1st of April 3000 to 31st March 3001. So some of this insurance relates to the first quarter of 3001. This £250 is not the full cost for the year 3000. Some of it needs to be deferred into the following year. So in accounting, we'll prepare an accounting adjustment, and we'll say we still have insurance to be used in the next year. So we call it a prepayment of insurance, so a resource yet to be used. So in accounting, we'll do our journal here, journal 2, and we work out £62.50 by dividing the total cost 250 by 4, which will give us the quarterly amount, and that quarterly amount relates to the first quarter of next year. So we've got £62.50, and we now need to reduce the insurance expense. So we would credit, so this is the P&L insurance expense line, which is a debit. To reduce it, so because we're deferring part of it to next year, we credit it. You see your insurance cost goes down. Okay. In my working trial balance here, I've labeled each of the accounts as either profit and loss accounts or balance sheet accounts. BS is balance sheet accounts, P&L is profit and loss accounts. So you can see with insurance, we're reducing the P&L, so we're crediting the P&L account. Obviously, we need to do double entry, and we show the other side as a prepayment, an asset yet to be used, and it's in the balance sheet. So when you're doing accruals and prepayments, as you do these journals, in the following year, in the year 3001, you'll need to reverse these journals, and accountants normally reverse them on the first day of the next period. And these type of journals are called reversing journals. And the reason you reverse them, in the case of the telephone accrual here, in the year 3000, you're going to receive the actual bill for telephone, and to avoid double counting in that period, you reverse the £47 because it will be included in that bill, so you're taking it out. And with regards to insurance, in the case of insurance, you've held back £62.50 into the balance sheet, but it relates to the year 3001, so you're going to reverse it into the P&L in the following year. So that's something to note about accruals and prepayments. Obviously, if the actual invoice doesn't come till 2 years later, you probably need to hold your accrual and prepayment for 2 years. You don't reverse them. Accountants normally review this every year to see if the accrual and prepayment is still valid. And one final thing on accruals and prepayments: if you're registered for VAT in the United Kingdom, you can create your accruals and prepayments net of VAT. That's because you'll be able to reclaim your VAT from the government. However, if you're not registered for VAT, you do your accruals gross of including VAT, because you can't claim the VAT. So the accruals and prepayments we've done are for expenses. You can also do accruals of income, and you can also defer income. And in the case of business trading stock here, if you have received money for goods you have not delivered, you not count that income in that year, you count it in the year you actually deliver the goods. And same if you're doing services, you allocate your income to the period in which you deliver the service or the goods. So in that case, you may have to defer some money you've received or some invoicing you've done to a following year. Similarly, if you've delivered the service or delivered the goods, but you for some reason have not yet invoiced your customers, so it's not showing up in your sales, but you know you definitely owed that income, you create an accrual of income. So you credit your P&L and you debit your balance sheet accrued income. So that is those are accounting adjustments that are done for businesses. So we're going to go to the next accounting adjustment for this business. So the business had bought a van. It cost it £3,000. Vans normally last more than 2 years. In this case, we're going to assume this van will last 4 years. So you want to spread the cost over the 4 years. You don't want this cost to be put in your profit and loss in the first year. One of the reasons for spreading the cost is you're going to get benefit, the business is going to get benefit for the use of that van over that period of time. In our example, we're assuming the benefit is going to be equal each year over the 4 years. So we'll divide the 3,000 by 4 and we'll get what we call a depreciation charge that reflects or allocates the cost of the van for each year it's being used. So we'd say in the first year we estimate the cost of the van use is 750, second year 750, and so on until in the end your record of the cost of the van comes to 0. This type of depreciation allocation is called a straight line allocation. So you're giving an equal amount each year. So if we do the journal first, so our journal is going to be journal number 3. And we're going to do in the P&L, we'll create a P&L depreciation charge account 3, and it's going to be 750. That's the cost in the P&L, debit, and the credit, we create an accumulated depreciation account in the balance sheet here, and that will be our journal 3, and we credit that. And basically in your balance sheet, you come to see in the later chapter, you see that the value of your van now is the 3,000 minus the 750, which would be 2,250. So that's your accounting adjustment for the cost of the van. As I alluded to, there's another way of calculating depreciation. It's called the reducing balance method. You probably find this in businesses. If you're not sure what to use for your business, you need to ask your financial advisor which is the best method to use. This second method basically takes 25% of the net book value of the van each year. So in the first year, the net book value is 3,000, so 25% of that will be 750. And at the end of the year, your net book value is 2,250. In the second year, you take 25% of your opening net book value, which is 2,250, which will give you 560, and so on. So each year, you're getting a reducing depreciation charge for the cost of the van. The reason for using this method as opposed to the straight line method is accountants reason that in the first years of the van, because it's new, you'll have less costs of repair, and you obviously get more benefits because of that. So the allocation of the cost should match the benefits you're getting. So it should be higher in the first years, and in the later years, the van will be older, you spend more on repairs, and therefore the benefit of the van will be less, and therefore you should allocate less of the cost to the later years. So that's the reducing balance. In our example, we're using the straight line method. Okay, and I'm going to go to the next page. We've got some more adjustments to do. So we have what we call the closing stock journal. You remember we did closing stock in, I believe it's chapter 9, and we valued the stock at £1,500. So if you want to revise that, how we got to that value, you can look at chapter 9. So what this is telling us is we've got goods in the company, we haven't sold them. In our trial balance, the 1,500 is still shown in the 13,000 pounds of purchases, and we're trying to calculate the profit and loss for the year 3000. So we should really reduce this purchases of goods by the stock that has not yet been sold, that is there at the end of the year. So to do that, as we said, we did a stock take, we calculated what the value of the stock is, and we'll enter a journal as follows. So we journal number 4, so do debits first. So you have an account in the balance sheet called closing stock balance, so journal 5. It's an asset, so you're going to debit it, 1,500, and the credit side would be in the P&L, in the profit and loss, and it will be a credit. And these two will be in the P&L, and you see that will be deducted from that value. It will become more clearer when we do the next chapter, the profit and loss account. Okay, so that is the closing stock journal. And then we've got one more journal to do. Now this journal is done after you've prepared the profit and loss account. So from what we got now, you can actually prepare the profit and loss account. But there will still be one more thing to do, and that will be calculating the tax charge. Now, I've already done it here for you, and I'm going to enter the journal. But when we come to do the next chapter, you'll see how we calculated the profit and how we then calculated the tax charge. So the tax charge journal here is going to be journal number 5, and we are going to debit the profit and loss account. So we now have an account here for the profit and loss. You see the green accounts here I've added to the trial balance so that we can do these journal adjustments. If you're using software, your chart of accounts will have these already in there. If not, you add them in. So journal number 5 for corporation tax, we'll say we've calculated it here, 1,000. If you have a tax department, your tax team will calculate it for you. You'll enter it in, debit. And obviously, you owe that money now to the Inland Revenue government, that is, and the credit side would be to your corporation tax liability in the balance sheet, 1,573. Yeah, and you can see your P&L coming there, the final TV and the balance sheet value there, and that would be the last adjustment in our working example. From this trial balance or extended trial balance, the accountant or yourself can now produce your final financial statements, which is the profit and loss account and the balance sheet, and we'll come to deal with those in the next lessons. Thank you for your time, and I'll see you soon.